So what are we trying to do when we say we're going to tax gross receipts? Where's that nexus between whatever it is we're trying to tax on the one hand versus how much we're taking on the other? Explain, if you will, that underlying justification for this approach as opposed to the income tax approach, which has other frailties but still justifications. You know them better than most of all of us.
Mr. Vice Chair, I think there's a number of issues in that question. I think first of all, if you address the fairness issue, equity, if you look at equity, and we normally think of it, particularly with a personal income tax, around ability to pay, which makes sense. I mean, that's kind of the basis for it. But oftentimes when you look at other taxes, in particular business taxes, you look at a different approach, which would be a benefit approach. So if you're thinking about businesses or property owners that receive services from the public sector, then their benefit could be measured by some a variable that measures their size relative to the economy, and that's where a gross receipts tax comes in. It's more of a benefit approach. And you recall, I'm sure very vividly, this in 2009 we came around the debate about, was $10 a sufficient corporate minimum? Everybody said no, that's ridiculous to pay $10, but yet if you're going strictly on a net income basis, $10 is too much. If you don't have any net income, it should be zero. So that led to a discussion, okay, that's not right. We should look at another measure of presence in the economy. And at that time, the decision was made, we talked a lot about value added, but the decision was made that Oregon sales or gross receipts was a measure of a presence or size in the economy. So you are shifting to a benefit approach and away from a more ability to pay approach. Now, you could argue there's advantages and disadvantages to that, but that would be the approach. The other thing from a state finance standpoint, of course, it makes a significant difference because you're going to a much more stable base where you have the present size of the business is contributing a certain amount to the public sector based on their relative size, not variations in their net income. So again, it's much more reflective of their presence in the economy. It stabilizes the state's financial stream significantly, and over time, it grows more over time. It doesn't shrink as our current base does. So those are the kind of factors that would come into play for your decision. The other thing, too, I think we should always keep in mind how our state taxes interact with federal taxes. Because at the federal level, you do have a net corporate income tax. You also have a net personal income tax. So you should look at those in combination.